the big brand VCs that everyone's heard of are losing money to inflation.
Why small funds can outperform, and also why liquidity is broken.
Only 10% of VC funds that are 400 million or bigger will ever deliver a 2x return after 12 years. So that means you have a 90% chance of not even getting a 2x.
How do you separate signal from noise when evaluating emerging managers?
I've taken your companies and put them into three buckets. Companies I wish I had invested in back when you did, ones that I'm sort of neutral on and don't really want to be in, and ones that are like clearly going to zero or I hate the topic.
All right. Hi, everyone. Welcome to Venture Signals. And today, Andrew is with me. So hi, Andrew. How are you?
Hey, Merve. Thanks for having me. Good to see you.
Thank you so much. So where are you right now?
I'm in Austin, Texas.
Great. And you have spent like more than 2 decades in venture. But what makes your perspective especially interesting is you focus less on the surface narrative of startups and more of the mechanics of capital itself after I talk with you. So through like 7BC, you built a model around an emerging managers, co-investments, and secondaries. You have a strong view on why small funds can outperform, and also why liquidity is broken, and what AI is going to mean not just for startups, but also careers and capital markets. So let's get started. Why do small funds outperform large funds?
Yeah. Well, first of all, this is just the fact. So, I mean, if you don't agree with this, that's like saying I'm a flat earther. You're wrong. The earth is round and smaller funds deliver more cash back to their LPs than large funds. Kaufman Foundation, it's just historical data over the last 30 years that a fund that's larger than $400 million in size, so maybe they raise a 500 or billion or multi-billion dollar fund every 2 or 3 years, those funds, only 10% of VC funds that are 400 million or bigger will ever deliver a 2x return after 12 years. So that means you have a 90% chance of not even getting a 2x. And I would argue that if you're illiquid, there should be a premium delivered to you for that lack of liquidity, that you can't just sell your Microsoft stock and spend it on something else as you need it. Whereas the smaller funds, and we have just like an explosion of emerging managers that, you know, have $5 million, $12 million. I mean, there's a lot of guys running out with a 2 million fund, which is not that interesting to us. But the smaller funds that are, you know, kind of in that sub 50 million, sub 100 million range, or even sub 150, I think they deploy their money at an earlier valuation than the big funds. So if you've got, if you and I were 50-50 partners on a $1 billion fund, even if we were funding the seed round and late seed and Series A of repeat founders that already know us, that would only be a small percentage of the capital. Most of the capital would be in these 25, 50 million, 75 million checks when the valuation is not that far from the exit. So the delta between entry point and exit is not that big. And then you've got these publicly traded hedge funds that are crossing over into Anthropic and OpenAI and privates, and they're used to investing in publicly traded only. They're crossing over and saying, look, I don't care if I'm overpaying. I'm price insensitive. I'm willing to pay above what it could be M&A acquired for today or listed on the stock exchange, because eventually it'll grow into the valuation. So I'm going to pay more than it's worth. And with time, I'll be profitable, and I get paid just for owning Microsoft stock as a hedge fund. So they don't care. They'll invest in the IPO and invest after the IPO, or just hold it. So the VCs that are big are competing with that. And even without that crossover hedge fund to private competition, you know, when you invest as a VC and you finally have the exit, I always like the CEO to send me a list of what was the multiple that the pre-seed made, what was the multiple that the seed 2 made, what was the extension of the seed, what was the late stage seed, what was the A, the B, the C, the D. And you'll see those last money in, they might have made a 1.18x return on that capital. But if they have a 2% management fee times 10 years, they lost money on that. Whereas for the early stage, you have maybe 20 or 30% of your money goes to zero because the company runs out of cash and just dies. And it's a total shutdown write-off. But one of them returns the whole fund. And then another one returns half the fund. Another one returns half the fund. And you've just completely eviscerated the performance of anybody that was over 400. So I'll try to keep that answer that short, but we could go for hours on a million reasons. One final one worth noting is that if your fund is $1 billion fund or a $500 million fund, you start saying, oh, if I'm going to take 2 board seats, I'm not going to be happy with ownership of just 3% of the company. So I need to own a big chunk of this company if I'm going to do it at all. So I'm either all or nothing. And then all of a sudden they're competing with Josh Koppelman at First Round Capital, who's amazing. Mark Andreessen sent a 50-seater jet to pick you up and fly you to San Carlos Airport and meet you at the Rosewood. That there's so much competition that they either have to displace Mark Andreessen and Josh Koppelman and Scott Sandell and win that deal, or they do nothing. Whereas the small funds has access to the same deal, and they're like, well, I only want to write a check for 1 million. The company's raising 12. Can you make room for me at 1 million? They said, how about 500K? They're like, okay, put me in for 500K. So when your fund is not that big, you actually can get into every deal when you demonstrate your value add, your network. I got friends in Istanbul. I can help you all over the world, right? So there's a lot of more complicated below the surface reasons. But simply put, big fund must invest in later rounds. They're just not going to make a 100x return, most of the time on that. Whereas earlier or smaller funds, they do make that.
And you only invest at final close. Walk us through exactly how that works and why most investors get it wrong.
Well, so first of all, with what we're talking about, it makes it sound like 7BC Venture Capital is a fund to funds only. The fund to funds is a small percentage of the capital that we deploy. Most of the money we invest on behalf of our LPs, we invest into startups funding their primary funding round, where the company is raising their round. We invest from seed to late stage seed, most of our money, and a little bit into Series A. So that's where we invest directly out of a direct VC fund. Next to that, adjacent, we have a fund of funds that invests in emerging manager funds. So we don't like the odds of I have a 90% chance of making less than 2x. I wouldn't do that with my mother's money or my money, And there's plenty of pension funds and endowments that don't get paid more or less in their job if that big fund makes a 1.2x or a 1.5x. It doesn't even impact their, income. And they're happy just to keep re-upping in the same funds. For us, we're looking for the emerging managers that are typically on a fund 4 or a fund 3, or at least a fund 2. And occasionally we'll go into a fund 1, but we basically will not invest in a VC fund unless we are essentially doubling our money on the minute that we invest. And we call this final close arbitrage. So in the life of an emerging manager, you're like a 2-time Y Combinator founder who sold money and sold some of your founder stock in the Series C, and you started spraying into everything at the pre-YC demo day dinners. And then, so you're investing in the best YC companies before demo day. And then after 3 years of that, you say, I'm going to hide all my bad investments and I'm going to pull together all my good investments to make a deck and go out and raise a fund. This person's never really been a VC before. They've done some angel investing. They're on a fund 1. We don't really want to invest in a VC with no track record, but for them, life will be, they'll be raising money every day with their right hand. And they are in the deal stream, so they're deploying money with their left hand. So they'll say, we're going to go out and raise a $100 million first-time fund, and I'll open it up on January 1st, and I'll close by March 31st. Guess what happens? They hardly raise any money, and they go, all right, we're going to extend the final close until June. So they raise some money from their friends, people that know them, and they start investing. And then they keep saying the deadline will now be the end of the quarter. And they're just not successful in rushing people. So they keep extending until they finally say, like, look, we've already invested in 15 companies. We probably have dry powder for another 5. And frankly, it's been 24 months or even 36 months. And it's time to raise fund 2. So we need to raise the next fund. And so we're basically going to stop taking money in on December 31st. And on January 3rd, when people are back from Tahoe, we're going to literally have a first close to the next fund. Maybe that's fund 2, maybe it's fund 5. And so you're continuously raising LP money, which, by the way, if you're listening to this and you're thinking about being a VC, don't. You don't want this lifestyle. It is miserable. Whatever you do now, it's better than being a VC. This is a horrible lifestyle of you're always raising, and then you'll get the guys that invested in your first close 36 months ago are going to re-up in the next close. And so you need that money. We position ourselves to be in your final close. And we say, let's get on a Zoom or meet in person. And I want you to show me every single investment you made. What was the date? What was the amount? What was revenue for the company at that time? How much did they raise? How much cash do they have in the bank? Have they raised money at a higher valuation since your first investment? So this is what we want to see. So if they've made 15 investments, we do more work to invest in a fund than we do to invest in a startup, because we got to go through every single startup and we look at what is ARR, annual recurring revenue now, how much cash, how fundable is this thing? And I feel pretty qualified to say how fundable any of this 15 are. What we expect to see is one of them already ran out of money. And so if they invested, say, 500K, the fair market value in this column in the Excel spreadsheet is 0. So we're like, okay, they're losing money on that. But don't worry, because they put in 500K to this one at a 20 million valuation. And now the company raised at 125 million valuation. So it's how many shares do they own? What was the price per share they paid? And now they still own that shares times the new price per share. So that makes up for the loss that they had on the other one that went to 0. And so you end up going through the whole spreadsheet and say, if the fair market value of all the money you have deployed, including 20% of the fund being management fee and expenses, so inclusive of the management fee and the dry powder, what is the total value to paid in? TVPI. And if there's been a distribution, did they recycle it back into the fund? But let's not get too complicated with recycling. Typically, there is no exit before the final close. And we want to see TVPI, total value to paid in, is 2x. So if I put in $5 million into the VC fund's final close, my financial statement should tell me that the fair market value of my position in that fund is $10 million. So we double our money the minute of entry point when investing in a VC fund. And if the VC says that's not fair, I've got guys that invested in my fund 100K, 500K, 5 million 3 years ago. I'm going to penalize you. I said, whoa, I'm not in the business of funding a YC dude who thinks he's going to be the world's greatest VC. I either let me in at cost or we're not investing. That's our whole thing. And so we want to be 2x on the way in, and we want to be able to make an assessment that we think it's going to 2x or 3x from here. So we've got a really good shot at our entire FOF landing at 3 to 5x with thousands of companies underneath it, so that we're providing steady quarterly distributions to our LPs.
Nice.
Oh, and of course, for every dollar we deploy in FOF, we're deploying like $5 on direct. So if I go through that whole portfolio, I'm hoping to uncover something in there that I like. And then say, why don't you introduce me to this founder? I'd love to invest in her next primary funding round. And then we could talk about how we actually get into secondaries when you want to talk about liquidity.
Great. Okay, now I have like a couple of questions for you. It's going to be like a lightning format. Okay, so I want you to answer whatever comes to your mind, like firstly. Okay, so how do
Sure,
you
let's go.
separate? Yeah, so how do you separate signal from noise when evaluating emerging managers?
Well, define what you really mean by a signal and noise. I mean, I hear people say it all the time, but I want to understand I'm answering your question properly.
So there are a lot of like, emerging managers that you need to decide. But there are some of them are they might be hype, like so many people are talking about it. So how do you understand, yeah, this is a real signal? No, this thing is actually something like a
I,
noise.
I would say we're completely immune to signal and noise,
Mhm,
and we look at what their background is. Will founders want to work with these people? And I think we're a good judge of that.
mhm,
And there's times when I love the manager, I love the VC, want to have them at our events and hang out and co-invest with them. But when I go through their fund, I'm like, whoa, put me in your next fund because this one is bad. This is really bad. I've taken your companies and put them into three buckets. Companies I wish I had invested in back when you did, ones that I'm sort of neutral on and don't really want to be in, and ones that are like clearly going to zero or I hate the topic. Like you got a baby size fund and these things need, you know, deep pocket investors. You're going to get wiped out on all of them. And if I can hardly have like only one in the bucket that I want to be in, then there's the bucket that I'm like, all right, I could get dragged into it to be in a trophy asset. And this stuff is just bad news. Like I don't want to invest in like gambling and guns and whiskey and selling drugs or whatever. Stuff I just don't want to be involved with. That in that case, there's no signal noise that could drag me into investing in that fund. We're very looking at each single company and looking at what is that performance now. Maybe they're only at 1.5x TVPI based on a completed financing, but somebody might have doubled their revenue in the month of February and then 3x their revenue in the month of March. And I'm like, all right, well, that thing is going to raise money at about this valuation. And this fund could even sell 25% of their position into that next funding round and return the whole fund back. And I can have a conversation with the GP of saying, look, how much you invest in this company at a 6 million valuation, then they raise it 300, then they raise it 600 million. How much have you sold? The guy's like, well, nothing. I'm like, all right, you are a child and an idiot. You should be selling shares. And when you go to all those people that knew you, that funded you in the fund one, return all the money to them by selling 10 or 25% of your position or 50. And then it'll be really easy to get spousal approval and all these husband and wife teams will re-up in your next fund. So the way we separate signal from noise, I suppose, is going through the entire portfolio and saying, sorry, we're not going to do it, but I like these three deals. Intro us, we'll go direct. And when you get to your next fund, we want to be in the final close again. And hopefully you don't repeat all these mistakes in your fund two or your fund four that you did on this fund, because this fund looks bad.
mhm.
I promise a shorter answer next time.
No worries. Yeah, no worries. So you have been thinking personally about what AI means for the next generation. What jobs or skills sets do you think most at risk, and which ones are gonna become more valuable from your perspective?
It's funny. I mean, I really feel bad for the generation of people that are coming, even interns. I have interns that are costing me more time on what they're doing for us than us just doing it with Claude kind of stuff. So, like, I don't even want to hire some of these people when it's free. And you really need to invest in a new employee that's a young person and be ready to be not just paying them money, but losing a lot of time. So you can be, if you measure how much time you're depositing into the ATM with them and how much time are you withdrawing, that they're saving us on time because they're doing some work. I feel like I'm unprofitable for at least a year right now because of AI. Whereas in the past, I would be like, hey, do this painful menial task for me. And I'm like, oh, it's great to have smart little Stanford people doing this for me. Now I ask them to do something and I'm like, you know what? Just forget it. I'm just gonna do it all myself. Like I'm using AI and there's kind of like to some extent, I only want to be working with people that have experience in a network. And they're like, well, why don't we do it this way? I'm like, brilliant, so smart. I'm not getting that from the freshly minted Stanford MBA, and I'm not getting it from that undergraduate either. So
So,
it's a tough time.
so do you think like business schools and MBA programs are adapting fast enough what AI is about to change, or they are
Not at all.
slow?
Not at all. In fact, I'm I'm planning on. I've got 17-year-old twin boys, and for like a summer project, I was thinking of like getting them involved on setting up like a series of podcasts with VCs, investment bankers, lawyers, people that are in the ecosystem, giving advice to high school high school kids, undergrads, and master's degree like MBA types on how can they survive and thrive in a world heavily impacted by AI. And I think the short answer is they need to be better at using AI than the company where they're interning at or seeking to get a job at. So, I've had associates that I had to let go that refused to do things using AI. And I'm sitting here like, dude, just use Claude for this. Have OpenAI and Claude and fight it out. Use Perplexity. What are you doing? And and I'm like, I'm the old geezer. The young person should be the one showing me how to use AI, you know? So it's really painful. I think it's really hard to see where are these people going to get their first 5 years experience when they've become somewhat of a unprofitable liability in these first 5 years. And being such an entrepreneur myself, I'm almost like, well, maybe what they should do is start companies kind of like Teal Fellow, do that to get enough experience so that you actually bring value, bring value to it.
That's good. I was almost going to ask you, like, if you were advising a smart young person today, how would you tell them to prepare an AI-shaped economy? So one of them you said become like Teal Fellow or something. So maybe top three things, what would be your advice?
I would say be better at AI than your boss. Be better at AI than all of your peers. And the person who is really naturally, natively curious of saying, I want to be a superhuman and harness, this is internet search with intelligence, with access to all of our proprietary data and all this other stuff, and just be that leader. There's going to be a place in every organization, whether it's a large corporate consulting, startups, government, healthcare, whatever, for the person who's really the best at AI for the person above them, next to them, and below them. And the short lightning answer to your other question is that people setting the curriculum at high school, undergrad, and MBA are dead and asleep at the wheel and should all be fired. I can't get my my boys are in entrepreneurship class here in Austin, and it's their favorite course. And the teacher should say every project has to be native AI. Like literally, it should all be native AI. Don't even waste your time on the lemonade stand. It's native AI or die. I went to my reunion for my MBA at Georgetown, and I, had lunch with the dean and said, "How have you changed the curriculum because of AI?" And he was completely defensive, saying, "AI will never replace the stuff we've been teaching for 30 years or 150 years." And I was like, wrong answer. Total wrong answer. So I think that nobody at the, I'm seeing, first of all, the whole curriculum was bad to begin with. Like how many hours should kids be on photosynthesis? It's ridiculous. and not a single hour on showing them how to use different AI and all this other stuff. I mean, is so stupid. I'd like to see high school train people to not go to college and be massively innovation economy, zero debt, go straight into have a one person business and blah, blah, blah. That's what they should be teaching as a track. It's not like vocational school. I didn't go to college. I'm a mechanic and there's a cap on what I could make. You know, Zuck never finished Harvard. You know, Bill Gates never finished. You know, so they're all dead asleep at the wheel, and they need radically to change their curriculums.
And 5 years from now, what will people realize they fundamentally misunderstood about venture capital during this period?
I think that it's still somehow not common knowledge that the big brand VCs that everyone's heard of are losing money to inflation. I think that they're you know, like we talked about at the beginning of our session, that, you know, over 400 bad, under, you know, above 150 probably bad, below, you know, above 25, below 50 very likely to be in the 7x, 10x, 12x territory. No chance when they get much bigger, you know, all that. I think that will become more common knowledge. I almost worry that, I mean, how many companies go to Y Combinator a year? And probably a third of them will get to a meaningful secondary for the founders where they're going to bank like 10 million bucks. And they're probably young enough to want to invest like $1 million into the next batch of YC companies. So I think that we're seeing too many founders, when they come into some money in their pocket from a secondary or an exit, their first thought is, I want to be a VC, where their first thought should be, I want to learn from my mistakes. And my next company, I'm going to go the distance and IPO it like I'm Steve Jobs and not do this quick flip to M&A that I did in the last one. Because I'm secure, I don't need a parachute, I'm set for life. I'm going to be Mark Benioff with this next one. I would like to see more founders not become VCs and continue to be founders. You know, so I think there's too many people entering the VC space, and that was part of my motivation to start a fund of funds, because there's a huge opportunity there. Almost no endowment, pension fund, insurance company, nobody's investing in them. They only get money from people that they know and friends of their friends. Some single family office money. So I think there's an evolution of capital markets that's changing. I think another thing is that it's common knowledge to me, given my background, about secondaries. But I think that there's a big misunderstanding from veteran VCs that have been around for a long time and the new VCs. The veteran ones are figuring it out of necessity, that it's not their job to just find the startup, source the deal, negotiate the deal, elbow their way in, get on the board, invest, add value, impact the exit, and raise the next fund. They don't understand that it's at the top of your job description is to sell shares on the secondary market and return cash to your LPs while this company is still privately held that you've invested in. Most VCs are sitting on their hands, having lunch with the CEO saying, did you ever think about meeting my investment banker friend about an IPO or M&A? What they should be doing is saying, well, we are up 8.5x. I think it's going to double in a year and then double again. Should I be selling? And the answer is yes. So I think what's going to be different 5 years from now, everybody is going to say, I invest as a VC into startups, you know, in late seed, pre-seed, whatever. And when I see the company raising at a much bigger valuation, I'm going to sell 10%, 25, 50, maybe even 100% of my position on the secondary market to the new investors coming in. And I'm going to offer my LPs the option to take the cash distribution so they can get all their money back. And then they're just playing with house money once they got all their money back. Or option two, they can recycle their distribution into the special purpose vehicle, SPV, to ride that winner and not sell now. And then option three is recycle and actually put more money in. Maybe they want to invest in Anthropic at a 700 billion valuation, or if they can get it at 590, you know? Whereas other ones are like, hey, we were in Anthropic at 68 billion. Maybe we should be distributing some money. So some take that distribution, some just recycle. I don't want to sell at 900. And some say, recycle me, and here's another 5 million of my personal wealth, because I believe that this will be minimum 3 trillion company. This is a great deal at $1 trillion or whatever it is. So this is an evolution of the capital markets where startups can stay private much longer. And the distance of time from a seed VC fund to the final IPO or M&A is longer in time than the guy who's coming in right before the IPO. Ironically, remember we were saying these crossovers overpay and they have to wait for the company to grow into that valuation? Well, the early stage guy could return his whole fund, her whole fund, faster than the late stage fund, because if they're investing in an AI native portfolio, some of these companies are going to blow up revenue so fast that they're going to raise at much higher valuations very quickly. And they could sell 10%, 25, 50% and return the whole fund with either one or three of them. So I think it's a big deal that very few VCs and LPs have a good command and understanding of the evolution of our capital markets, that there is liquidity available for the VC that has skills in selling stock in a privately held company to another investor and return money faster. And when you can return all your money in 2 years and you go back to the same LP and say, invest in my next fund, and we only sold 25 or 50%, we still own part of that Anthropic and it's going up. So they're all going to re-up in your next fund. And when you go to new LPs and say, invest in my new fund, even though you didn't do the last one, and I'm in the top 10% for my vintage on my DPI, my distributions paid in, how much have I returned? Better than 95% of all the other guys out there. That's attractive to a new LP you're meeting in New York or Singapore. They're like, I get this guy my money and I get it all back within 2 or 3 years. I like the sound of that. I gave this other guy all my money and he sits on his hands, does nothing, waiting for an exit. And it's been goddamn 7 years and I don't have my money back yet. That's bad. So that'll be a big change, understanding liquidity and how to work it to really achieve it and be balancing that.
That's great. Yeah. So thank you so much, Andrew, for your time and all of your comments. I think it was a great one. Yeah. Thank you.
Thanks for having me. Happy to do it anytime.